Okay, students, I ended the last video talking about income statement presentation of held to maturity securities, and we see that played out down here in these financial statements. Again, income statement presentation, realized gains and losses are shown in net income when we sell those securities or any other way dispose of them. Unrealized gains or losses don't show up anywhere. They're reported on the balance sheet at amortized cost, less any allowance for credit losses. There's amortized cost. Fair value is ignored, so it doesn't play a part up here in the income statement. On the statement of cash flows, buying or selling of held to maturity securities are in the investing section of the statement of cash flows under investing activities, and interest revenue shows up on the statement of cash flows under operating activities. So we see that down here. Here's a statement of comprehensive income. And as an element of net income, right here we see the interest revenue. And notice that includes the amortization of the discount. And then in the balance sheet, in the asset section, we see the investment in the bonds at net book value. And there is the retained earnings section. We have the net income flowing into retained earnings. So this is the sum of the 2 years' interest revenue. And then the statement of cash flows under operating activities, we see the interest receipt. And here under investing activities, we see the purchase and then the sale in 2022. So we sold those before their maturity, before even the second. The second interest period did occur, but not the third. Okay, I think that pretty well covers held to maturity securities. Let's move on down to trading securities. Now, financial institutions are the primary group that reports trading securities, since they actively trade securities quite commonly. Most other organizations don't have these. They're typically reported as current assets because we are actively trading them. And let's see, what else do we have down here? Trading securities are written up or down to their fair value, or often referred to as mark to market, on the balance sheet, and any corresponding unrealized holding gains or losses are included in net income. Okay. Move on down here. So again, they're reported at fair value on the balance sheet, and any adjustments to get to fair value are reported in net income. Here you see the journal entry to record fair value. So we debit the fair value adjustment. Now that is a adjunct account to the investment account, and we credit gain on investment. So this is an asset. We've increased assets, and we credited gain on investments unrealized in the income statement, in net income. Okay. Now, in case you're wondering, why don't we just debit the investment rather than the fair value adjustment? Well, there is still a desire to keep track of the original cost of the investment. So ultimately, we can see, were we profitable are unprofitable on that investment. So rather than debit or credit the investment, we use the fair value adjustment account. Okay, and again, unrealized, that means we haven't sold them. Holding gains or losses for trading securities are included in net income in the period in which the value change occurs. And here you see examples of how these are presented on financial statements quite often. Well, actually, they're just showing you a problem, and there they're making the adjustment, kind of netting out all of the increases and decreases. Now, sale of trading securities, first thing we do is adjust the trading securities to fair value at the time of the sale. So we go through this adjustment that we had right up here. So if we sold it on January 25th, we would identify fair market value on January 25th, which would be the selling price, and adjust to that selling price using the fair value adjustment and recognize any gain or loss that hadn't been recorded. So that's what they're talking about down here for trading securities. Unrealized holding gains and losses from fair value changes are recorded up to the date an investment is sold. So again, we see that debit the fair value adjustment, credit the gain, and then when we sell it, we debit cash for the amount of the sale. We credit the investment for the net book value, debit the discount to remove it for any unamortized discount, and then we credit the fair value adjustment. So these two are removing the two accounts that are associated with the bonds on the balance sheet, the bonds that were sold. Okay. Now we have a couple of homework problems on that. So let's jump over there and pick up those. And so we are looking at brief exercise 12.2 and 12.3 up here. And so brief exercise 12.2, S&L Financial buys and sells securities. Sorry about that. I was just getting my clock back up there so I could see how the time's going. S&L Financial buys and sells securities expecting to earn profits on short-term differences in price, trading securities. Okay, that's what you're doing with trading securities. You're trying to get an increase in price, short-term difference in price, but an increase in price, and then sell them at a gain. So this tells us it's trading securities. On December 27th, 2027, S&L purchased Coca-Cola bonds at par for $875,000, sold the bonds on January 3rd, 2022 for $880,000. On December 31st, the bonds had a fair value of $873,000. What pre-tax amounts did S&L include in 2021 and 2022 net income as a result of this investment? Well, they bought the bonds December 27th for $875,000. At December 31, the bonds had declined in value to $873,000, so they're going to show a $2,000 loss in 2021. Now, then on January 3rd, 2022, they sold the bonds for $880,000. So at December 31, we had the bonds recorded on the books at a net book value of $873,000. We sold them for $880,000, so the difference there is $7,000. So we're going to show a $7,000 gain in 2022. So a $2,000 loss in 2021, $7,000 gain in 2022 equals the $5,000 increase in value from the time we bought them till the time we sold them. So there is the answer. And you see 2021 unrealized holding loss of $2,000. 2022 unrealized holding gain of $7,000, although that actually does wind up being realized when we sell it. So it's net gain of $5,000. All right. And let's go to the next one. And there it is. For the Coca-Cola bonds, prepare the 2012, described in 12.2, prepare the journal entries to record any unrealized gains or losses occurring in 2021, the sale of the bonds in 2022. So there, we'll just pull it up and look at those. So there we see the loss being recognized at December 31, 2021. Debit loss on investments. Credit the fair value adjustment because it's a reduction of the bonds. So this account then, in that case, if the $2,000 is its balance, it will be a contra asset. Then on January 3rd, but when we sell the bonds, first thing we do is do the fair value adjustment. So we are going to record the fair value adjustment right here, debit the fair value adjustment for $7,000, and credit the gain on investment to net income of $7,000. So we had a $2,000 loss here, $7,000 gain here, so a net gain of $5,000 between the 2 years, and the fair value adjustment, credit of $2,000 here, debit of $7,000 there, so that gives us that $5,000 balance, debit balance right here. And so now when we sell them, we debit cash for the selling price, credit the investments at what we paid for them, and then credit the fair value adjustment at its balance. Okay, that gets us pretty close to the end of the time I have available. So I'll go ahead and close off the video now, and we will pick up there with the next video with the financial statement presentation.